Fellow Singaporeans, what if you could collect steady dividends while riding the biggest AI boom of our generation? That's exactly the promise behind Keppel DC REIT. And right now, there's a preferential offering at $2.24 that closes on 13th October 2025. Today we'll unpack whether this deal makes sense for existing unit holders and for new investors. We'll cover what REITs and dividend investing are, Keppel DC REIT's business model and portfolio, its latest first half 2025 results, whether it's cheap or expensive at $2.40, dividend yield and sustainability, and finally, a simple cost-benefit view of the preferential offering. This video was actually requested by one of our viewers, so if you want your questions featured, remember to leave a comment below. Stay till the end, because I'll share my final take and a key deadline reminder you don't want to miss. And if you find this useful, smash the like button so more Singaporeans can see it, and subscribe to Wealth for You for more simple, data-driven dividend insights. Quick disclaimer. This is for education and entertainment only, not financial advice. All financial numbers in this video are downloaded directly from Keppel DC REIT's official announcements on SGX. Always do your own research and consult a licensed financial advisor before making any investment decisions. Chapter 1. REITs and Dividend Investing. REITs, or Real Estate Investment Trusts, are listed vehicles that pool money from many investors to buy income-producing properties. In Singapore, REITs have a special rule. They must pay out at least 90% of their taxable income as dividends. That's why they're so popular with income investors, because you get consistent distributions, usually every quarter or half year, without managing tenants yourself. Instead of buying a condo and worrying about finding a tenant or fixing leaking pipes, you can own a slice of a diversified portfolio of malls, offices, warehouses, and in Keppel DC REIT's case, data centers. And the best part? The income is spread across many properties, and professional managers do the heavy lifting. Think of dividend investing like planting a durian orchard. You plant the trees today, you water and nurture them, and over time the fruits keep coming back season after season. Some years are bumper harvests, some are leaner, but if you plant wisely, you'll always have something to enjoy. Chapter 2. What is Keppel DC REIT? Now let's talk about Keppel DC REIT, or KDCR for short. Unlike the usual REITs you hear about, those owning shopping malls, offices, or industrial warehouses, KDCR is in a very special niche: data centers. These are the factories of the digital age that keep the internet, AI, and cloud services running 24/7. Every time you stream a video, store a file on the cloud, or even ask ChatGPT a question, somewhere in the world, a data center is working hard behind the scenes. As at 30th June 2025, KDCR owns 24 data centers across 10 countries, with total assets under management of around 5 billion Singapore dollars. The portfolio is tilted towards Singapore. About 66% of the properties are here at home, with the rest spread across the Asia-Pacific region, making up 81% in total, and Europe, which is 19%. Operationally, KDCR is solid 95.8% occupancy and a long WALE, weighted average lease expiry, of 6.9 years by lettable area. This means their tenants, many of which are big-name cloud and hyperscale clients, are committed for the long term. Even more impressive, in the first half of 2025, they achieved a positive rental reversion of around 51%. That's one of the strongest reversions we've seen among Singapore REITs this year. So in plain English, KDCR has long leases, high occupancy, and rents that are stepping up sharply, all of which position it perfectly to capture the booming demand for AI and digital infrastructure. Chapter 3. What changed? The turning point in Keppel DC REIT's 2025 growth story. So how did Keppel DC REIT actually perform in the first half of 2025 compared to last year? In one word, impressive. Gross revenue jumped to about $211 million, up a strong 34%. After expenses, net property income climbed even faster, up 38% to around $183 million. But here's the figure income investors really care about. Distributable income, the pool of cash available for payouts. That soared by more than 57%, reaching $127 million. And what does that mean for you as a unit holder? It translated into a distribution per unit of 5.133 cents, which is a healthy 12.8% increase year on year. That's not just growth, that's dividend growth, which is what keeps investors smiling. What's equally important is how the REIT managed its balance sheet. Cost of debt is steady at about 3%, aggregate leverage remains conservative at 30%, and the interest coverage ratio improved to 5.9 times. In other words, KDCR isn't stretching itself. It's growing responsibly. Where did this growth come from? Mainly new assets in Singapore and Tokyo, higher rents through escalations, and strong renewal reversions. These gains more than offset the impact of a few divestments and a provision taken for its Guangdong data centers, which the market had already been aware of. The bottom line? Keppel DC REIT delivered strong growth in both income and distributions, while keeping its financial footing conservative. That's a combination dividend investors love to see. Chapter 4. Is KDCR cheap or expensive at $2.40? So, with Keppel DC REIT closing at $2.40 on the 3rd of October 2025, is this price considered cheap or expensive? Let's break it down. At that price, the REIT's market capitalization works out to about 5.4 billion Singapore dollars. When we compare the unit price to the underlying book value of its assets, the NAV of $1.58 per unit. The price-to-book ratio comes in at roughly 1.5 times. That's quite a premium, because many other REITs in Singapore trade closer to book value, or even at a discount. If we look at earnings, the trailing price-to-earnings multiple is around 14 times. That's not sky-high, but it does suggest investors are paying up for the stability and growth story. On profitability, return on equity sits at about 10 to 11%, which is healthy for a REIT. And when it comes to debt, the balance sheet is still conservative. Aggregate leverage is just 30%, leaving plenty of headroom below MAS's 50% ceiling. So, what's the takeaway? KDCR is not a bargain bin REIT. It doesn't offer the highest yield or the cheapest valuation. Instead, you're paying a quality premium for exposure to mission-critical data centers, long leases, high occupancy, and the growth potential tied to AI and cloud demand. In short, it's priced as a growth and stability play rather than a pure high-yield income play. Chapter 5. Dividend Yield and Sustainability. So let's get to the big question on every income investor's mind. How much income are we talking about? At the recent price of $2.40, the trailing dividend yield works out to roughly 4.2%, based on the distributions paid over the past 12 months. If we take the latest half-year DPU of 5.133 cents and simply annualize it, the forward yield comes in around 4.1 to 4.3%. That's not the highest yield in the REIT universe, but it's steady and backed by a specialized asset class. Now, is this dividend stream sustainable? Let's look at the foundations. Keppel DC REIT's distributions are closely tied to its distributable income, and capital-intensive items like asset enhancements are carefully managed through reserves rather than eating into payouts. Financially, the trust is in a strong position. Gearing at 30% gives it plenty of room before MAS's 50% cap, and an interest coverage ratio of 5.9 times shows it can comfortably service its debt. Operationally, the portfolio also supports sustainable cash flow. 95.8% occupancy, a long WALE of 6.9 years, and a remarkable 51% positive rental reversion achieved in the first half of 2025. All these factors suggest a solid base for maintaining dividends. Of course, no REIT is risk-free. Investors should keep an eye on tenant concentration. Many of KDCR's revenues come from a small number of hyperscaler clients. There's also exposure to foreign exchange fluctuations given the global portfolio and the usual execution risks when it comes to completing acquisitions or upgrading data centers on time and on budget. But taken together, the story is reassuring. Keppel DC REIT's dividends are not just sustainable, they're also positioned to grow alongside the world's demand for digital infrastructure. Chapter 6. Preferential Offering. Explained: terms, deadlines, and listing dates. Now let's get to the main event. The Preferential Offering, or PO, that Keppel DC REIT has launched for existing unit holders. Here's how it works. For every 1,000 units you already own, you're entitled to subscribe for 80 new units. The subscription price is $2.24 per unit. That represents about a 5.2% discount. Though to be precise, the official announcement compares it to the volume-weighted average price of $2.36.22 on 22 September 2025, the day the agreement was signed. At the recent market price of $2.40, the discount looks about the same. Altogether, KDCR is seeking to raise roughly $404.5 million. And where's this money going? According to the official use of proceeds, a large portion will go to part-fund the acquisition of Tokyo Data Center 3, which comes with a 15-year lease to a Fortune 500 hyperscaler, a strong anchor tenant. About $53.9 million will fund an asset enhancement initiative at Keppel DC Singapore 8, as well as the cost of a 30-year land lease extension for Keppel DC Singapore 1. And approximately $104.5 million will be used to repay borrowings, helping to strengthen the balance sheet. Now for the dates. The offer closes on 13th of October 2025. Make sure to check the cutoff time depending on how you apply, whether that's ATM, internet banking, or through CDP. The new units are expected to be listed and credited on 22nd October 2025 at 9 a.m. on SGX. What does this mean for investors? Because this is a non-renounceable offering, if you don't subscribe, your stake will be diluted. If you do, you're buying more units at a discount. Management has also guided that the fundraising should be DPU accretive, with pro forma estimates suggesting around 3% higher distributions once the new assets contribute. In short, this PO is both about growth and strengthening the base, new income from Tokyo, upgrades to existing assets, and a cleaner balance sheet. Chapter 7. Who should subscribe? What if I'm new? So, the big question. Should you take up the preferential offering if you're already a unit holder? And what if you're not? If you're an existing unit holder, this offer looks quite attractive. You get to subscribe at $2.24 per unit, a discount to the market price of $2.40, and because this is a non-renounceable offer, subscribing helps you avoid dilution, meaning your percentage ownership in the REIT stays the same. Here's a simple example. If you currently own 10,000 units, you're entitled to buy 80 new units for every 1,000 you hold. That's 800 new units. At $2.24 per unit, it'll cost you about $1,792 in total. If the market price remains around $2.40 after the new units are issued, you've already locked in a small paper gain, on top of reinforcing your stake in the REIT. Now, where's the money going? Part of the proceeds will fund Tokyo Data Center 3, which comes with a 15-year lease to a Fortune 500 hyperscaler, an extremely strong tenant. Some will go towards asset enhancement works in Singapore, like AEI at Keppel DC Singapore 8 and lease extension for Keppel DC Singapore 1, and about $104 million will be used to repay borrowings, improving the balance sheet. And remember the fundamentals we talked about earlier. Keppel DC REIT owns 24 data centers across 10 countries, has a high 95.8% occupancy, a WALE of 6.9 years, and delivered a 57% jump in distributable income in the first half of 2025. With 30% gearing and a 51% rental reversion, this is one of the stronger, more resilient REITs listed on SGX. So subscribing at a discount is more than just getting a cheaper entry price. It's about reinforcing your position in a REIT that has consistently grown its income, kept its balance sheet conservative, and positioned itself for the AI and cloud computing boom. Of course, nothing is risk-free. You'll need to set aside extra cash, and the DPU accretion depends on management executing the Tokyo and Singapore projects smoothly. There's also some tenant concentration risk, given the heavy reliance on a few large hyperscalers. But if you're confident in the fundamentals, subscribing is a sensible and strategic move to grow your dividend income. Now, if you're new to Keppel DC REIT and didn't hold units on the record date of 30th of September 2025, you can't join this preferential offering. Your option is to buy in the open market at around $2.40, which gives you a yield of about 4.2%. That's lower than some high-yield REITs, but remember, KDCR offers stability, high-quality data center assets, and long-term exposure to the AI infrastructure theme. Some investors might prefer to wait until after 22nd October, when the new units are listed. Sometimes, the larger unit base causes a short-term dip in price, giving a better entry point, though of course markets have a mind of their own, and there are no guarantees. Chapter 8. Fed Cuts. Before we wrap up, let's zoom out and talk about the bigger picture, the macro environment. All eyes are on the U.S. Federal Reserve, which many analysts expect to start cutting interest rates towards the end of 2025. And when rates go down, REITs often shine. Why? Because lower rates mean cheaper borrowing costs for the REITs themselves, and suddenly their dividend yields look far more attractive compared to bond yields that are falling. For Keppel DC REIT, this could be a meaningful tailwind. With leverage sitting at just 30% and an interest coverage ratio close to 6 times, KDCR is financially well-positioned to benefit if funding costs ease. That means more flexibility for acquisitions, potential DPU growth, and possibly even a re-rating in unit price, as investors rotate back into yield assets. In short, if the Fed does cut rates, the environment could turn from a headwind to a gentle tailwind for quality, cash-generating REITs like Keppel DC. Final thoughts plus deadline reminder. So let's bring it all together. Keppel DC REIT stands out as a quality, growth-tilted income REIT. The first half of 2025 showed strong performance. Revenue up 34%, distributable income up 57%, and DPU up nearly 13%. It has conservative gearing, healthy rental reversion, and exposure to one of the most powerful megatrends of our time, the digital and AI infrastructure boom. At $2.40, KDCR isn't cheap when you look at its price-to-book ratio of about 1.5 times or its yield of around 4.2%. But investors are paying a premium for resilience, for assets that keep the internet and AI running, day and night. The preferential offering at $2.24 is a practical and strategic move for existing holders who want to defend their yield, average down their cost, and participate in future growth. Just remember the key dates. Closing date, 13th October 2025, and listing date, 22nd October 2025 at 9 a.m. on SGX. For existing investors, this is your chance to reinforce your position in a proven dividend generator. For new investors, it's a story worth keeping on your watch list. especially if you believe in the AI-driven future of data. If this video helped you understand Keppel DC REIT better, please like this video so more Singaporeans can see it, and subscribe to Wealth for You for more data-driven, down-to-earth insights on building sustainable dividend income. And as always, this video is for education, not financial advice. All data used comes directly from Keppel DC REIT's official SGX filings and announcements. Always do your own research and consult a licensed advisor before making investment decisions. Remember, wealth is for you. Stay invested, stay informed, and I'll see you in the next one.